Welcome to The Explainer. Today, we're going to dive into a story that's nearly 2 centuries old, the California Gold Rush. Why? Because as you'll see, it's basically the blueprint for every single financial bubble that's ever happened since. All right, let's jump right in. We're starting with the big mystery, this paradox, really, at the very heart of the gold rush. It's what makes this whole thing so fascinating. So here's the puzzle, right? How on earth did an event that bankrupted pretty much everyone involved, how did that become one of the most transformative economic moments in all of American history? It doesn't seem to add up. You know the dream. We've all seen the movies, striking it rich overnight, finding that giant nugget. But the reality? Well, it was brutal. The guy who first discovered the gold, James Marshall, died broke. The very first millionaire the rush created, a guy named Samuel Brannan, he died broke too. And the huge majority of miners, they just went home with empty pockets, if they were lucky. Think about this number. Historians figure that only about 1 in 20 miners actually walked away from California with more money than they showed up with. Just let that sink in. 1 in 20. The odds were just abysmal. So how does something like this even happen? Okay, let's break it down. We're going to deconstruct the gold rush and pull out the core patterns, the blueprint, really, for every single financial frenzy since. You see, every one of these bubbles, they follow the same script, almost like a 4-act play. First, there's a new discovery, a new opportunity, and a few early winners hit it big. I mean, spectacularly big. That's what creates the hype, right? Which leads to stage 3, full-blown mania, where everybody and their brother rushes in. And then, the final act, the squeeze. The resource dries up, reality sets in, and the whole thing just collapses. Okay, let's talk about Samuel Brannan. He became California's first millionaire, but get this, he wasn't a miner. He was a shopkeeper, and he had this one brilliant insight. The real money wasn't in digging for gold. Nope, it was in selling the dream of finding gold. And this is just genius, really. Before he ran through the streets of San Francisco shouting, "Gold, gold!" You know what he did? He quietly went around and bought up every single pickaxe, pan, and shovel he could find. Every one. Then he turned around and sold those pans, which were worth maybe 20 cents, for $15 a pop. He made an absolute fortune off the hope of others before a single one of them had even started digging. So what fueled this whole frenzy? Well, it was a massive imbalance of information. You had these incredible stories of striking it rich, right? Those spread like wildfire back east in newspapers and letters home. But what about the much, much more common stories? The ones about failure and hardship and going completely broke? Yeah, those stories, they tended to stay buried in the gold fields. Nobody wanted to write home about that. And then there's this powerful psychological trap, the sunk cost fallacy. I mean, put yourself in their shoes. You've sold your farm, you've spent 6 months on a dangerous journey, you've sunk your entire life savings into this. You can't just pack up and admit it was all a huge mistake. No way. You have to keep going. You tell yourself, I'm just one more pan, one more lucky strike away from getting it all back and then some. Okay, so if the gold rush was such a personal disaster for so many, how in the world did it end up building a nation? Let's look at the flip side, the massive unintended consequences. Because while all these individuals were going bust, something truly incredible was happening on a much bigger scale. The rush was like a giant economic shockwave. It basically took decades of normal migration and development and crammed it into just a handful of years. Think about it. California's population went from maybe 14,000 settlers in 1848 to over 250,000 by 1852. And San Francisco? It went from a sleepy little village to a massive, bustling city, like overnight. And with all those people came this enormous demand for, well, everything. And this is where some real fortunes were made, not by individuals, but by companies. A guy named Levi Strauss shows up to sell canvas for tents, but then he realizes what miners really need are tough pants. Ring a bell? And Wells Fargo? It was literally created just to handle the banking and shipping for the goldfields. These weren't just flash-in-the-pan businesses. They're giants that are still around today. And here's the really crucial takeaway on the national level. All that gold didn't just stay in California. It flooded into the US economy, and it financed, well, everything. We're talking railroads, factories, the whole industrial revolution. That capital fueled the explosive economic growth of the North. You could even make a strong case that the wealth from the gold rush was a major factor in the Union winning the Civil War. So this is where it all gets really interesting, where this isn't just a history lesson anymore. The gold rush basically exposed a glitch in our human programming, a template that has played out again and again and again in financial markets ever since. Think about it. It doesn't matter if it's gold in the 1850s, dot-com stocks in the late 90s, real estate in the mid-2000s, or crypto in the last few years. The pattern is exactly the same. You've got the shiny, speculative thing everyone is chasing, and then you've got the shovels, the infrastructure, the platforms, the services, and that's where the real steady money is almost always made. Now, the big difference today is speed. Technology and social media mean these bubbles can inflate and pop in a matter of months, not years. But here's the kicker. Our brains haven't caught up. Our fundamental psychological weakness for that promise of getting rich quick, it hasn't changed one bit. So what's the point of all this? What can a story from 175 years ago possibly teach us about how to navigate our world today? This, right here, is the big question. It really boils down to three key things. First, you have to learn to spot who's really making the money. Ask yourself, who's selling the shovels in this scenario? Second, remember that just because something is a world-changing technology doesn't mean you'll get rich by speculating on it. Those are two very different things. And third, and this might be the hardest one, we have to be honest about our own psychology, our own weaknesses. And that brings us to the big one, FOMO, fear of missing out. It's the engine that powers every single one of these bubbles. It's that gut-wrenching feeling of watching everyone else get rich while you're stuck on the sidelines. And that feeling, it is incredibly powerful. It just short-circuits the rational part of our brain. So, in the end, after looking at 175 years of this repeating pattern, it all comes down to one critical question you have to ask yourself the next time you hear about a can't-miss opportunity. The people who tell you there are shortcuts, they are always selling shovels. The only real question is, are you going to buy one?